Hi, welcome to Market Outlook for August 2025. As you know, I represent Pranitya Wealth, and Pranitya Wealth is a mutual fund distributor. So this video is only for educational purpose, not soliciting any investment, and not for those who are not our clients. Simply educational and nothing beyond that. Quickly moving on to the, I think we need to address the global landscape first, and that to US because a lot has changed post these tariff tantrums we just started a couple of months ago. Why US become more important? Mostly it is the largest economy. It also the tariff also changes, charges changes the way trade is done. The changes the supply logistic and business strategies in general. A lot of business is done in dollars, so that also matters. And secondly, U.S. Though economy wise the largest, plays a very important role of daddy in the global economy. So let's look at what is happening there. They have concluded most of the talks, the major ones with the EU and Japan, which according to us was very important. That is successfully done. So they might avoid that mild inflation, which was the expectation. US may grow at 1.8, 1.7% because first quarter one of US was 0.5% contraction in economy, and second quarter was 3% positive surprise in terms of rise in the economic growth. For Q1 means for US is January to March, and Q2 is April to June. So that changes from India. So Fed is in a wait mode. Of course, now most of the deals, tariff deals, been announced. But this time around, Fed will not take any action. They are not taking any action, and they might wait for fallout of the tariff impact globally and particularly on the US. Uh, there is no change in the US yield, indicating 10 years around say 4.35 and 30 years around 4.85. Indicates there could be some kind of a slowdown in the economy. The inflation might bite, the fiscal deficit might not be addressed the way it is, and there is a short-term blip possible. Evident that some job losses are being seen, and also the spending cut in terms of grants and educational institute and medicine and social security has started impacting American in general. Let's move on to the India-US relationship. That's very critical. We are in the mode of discussion, and still Trump has gone ahead and announced 25% tariff on India, along with some penalties. Very difficult to understand what is going on in his mind. Broadly speaking, I think the equation with Modi has changed a lot, and there is a grapevine that people say Modi has not honored his request for doing a Modi Howdy before the election. So that has gone a bit sour with Mr. Trump. Nobody knows what the fact is, but his body language is quite evident. So he won't. Why he is after India? I see a couple of reasons. Like the what MAGA, that is Make America Great Again, want to bring back the businesses to US, but all that is going to take time. What is important for Trump is oil and ammunition. That is ready, and he want all the economies, all the countries to buy ammunition and oil from him. India again is a very large market, and as of now we just buy $5 billion of oil from US, and we export about $80 billion of goods with very minuscule tariffs. That is biting him more than anything else. He is trying all his pressure tactics to make India come to terms. And finally, he want revenue. He want his fiscal deficit to be reduced, and he might achieve something from these negotiations before we end tariff, discussions. So the impact on India of this tariff has been debated a lot. Nobody knows exactly how that Russian sanctions will work, but if that happens, we might lose $6 to $7 billion in terms of the Russian oil not being imported, or on oil count, you can say, and maybe the impact on overall GDP will be about 0.2 or 0.3% max. Already Moody's has gone and cut the India's GDP growth for the next 26, 25, 26 to about 6.3% from 6.5%. So general consensus is not going to impact too much on India. Quickly moving on to the inflation, which is again a point of discussion. We last reported number of 2.1% in India. It indicates some kind of a slowdown in consumption. You know, India is a consumption economy, and consumption for us is very, very important. We are never an investment economy. So this slowdown in consumption may be attributed to the early monsoon or holiday season where people tend to travel a lot. So we are not taking very seriously at this stage, but this number is to be watched. 2% is not a good number, and this might some amount of growth is very important before we can conclude somewhere in September next quarter as to how this growth and inflation pans out in India. Uh, Going back to the Indian growth, I think the broader number in terms of GDP, tax collection is in very much in tune. The GST is not showing any kind of slowdown. Income tax collection is good, but this year we issued more of a refund. So what it means, maybe government has made banks to pay more advance tax in the last year to show the numbers good, but eventually they are gone and refunded. And also the stock market, which made a lot of individual to get some refunds at the end, because March we'd seen great amount of slowdown and drop in the market, and that made people book some kind of losses and set off against their gains, and they must have got some refunds. That's a reading in terms of the huge refunds been issued last year. So looking at 3-4 sectors, either from the consumption point of view and from the Q1 results which has come till date, the IT sector, auto sector, and the real estate has seen significant kind of a slowdown. And as you know, the IT leads the eventually feeds the auto sector and the housing sector, because somebody gets job in IT sector will buy a car and a small house, and that is these three sectors are large employment creators in India. So we feel slowdown in IT will hurt eventually, and we need to really watch for as to what IT sector is going to do and how US is going to behave in. Of course, now IT has shifted their focus to European Union, but that might take time. And secondly, that market may not be that big as the US is. So, in terms of slowdown, yes, we got 950 companies reporting their first quarter numbers till date, and growth seen is about hardly 6 to 7% in terms of the net profit. So earnings growth again might become a challenge like what we see in the last year. The returns from most of the top mutual funds were very, very minuscule in the last 1 year, and Nifty speaking as of 30th of July virtually at the same level which was there in 2024. So wealth creation was not really happened in last 1 year. I think so Indian growth is to be watched very, very carefully. We believe second half of this year is going to be better because of the festive season. Good monsoon might help the rural consumption, which is seen in the last in the month of July. We have seen some kind of uptick in consumption, and that's how our stand substantiated the spending by government might take a bit of a longer time to percolate down, and the consumption will eventually pick up. Government is very sacrosanct of this slowdown, and they are doing the heavy lifting. They have spent a huge amount of capex in the last month, and which should ultimately result in kind of a pickup in the economic growth. That's what is expected. Valuation of market always debated. We are trading at some 23 times P on a holistic basis. Nifty, I am saying. But this number to be watched in isolation is a myth. So I just explain you how it is. So historical average is about 18 and a half, or if you will take last 5 years, 20, 21 times, and suddenly we have gone to 23 times. What has happened in Nifty? Composition has changed a lot in last 4-5 years. A lot of high growth companies have figured in the Nifty 50. So Eternal, which is very high, these are high growth and high PE companies. So naturally, P of the Nifty is up, and which could it can be we have to take an stance or strike and accept it, and not to get worried because of the broader P of the Nifty is very high. So it doesn't signify anything. Just because of inclusion of high P companies in Nifty has made this Nifty average going up. Q1 result, as I discussed, very minuscule growth in most of the banks and IT companies. IT companies margins are hit. Banks NIMs are hit because of the when interest rates are down. The first adjustment happens in the loan, so that is their income. So interest rate on loans goes down, and subsequently followed by the deposit rates whenever they mature. So if somebody has done 10-year deposit, his rate gets adjusted after 10 years. So you will understand whenever rate goes up, bank benefit, and whenever it goes down, in the short term, banks lose, or they have the pressure on the NIMs. Secondly, we've seen some pressure coming from the banks shift to commercial or the consumption loans or personal loans from the industrial and corporate loans. Corporate loans and industrial loan, as you know, have been slowed down significantly over a period of time for want of the. I think they have better cash flows with the corporates. They have better profitability, and how they have not resorted to bank funding. Second reason could be the capital market. You see, last 2-3 years, number of IPOs which we have seen, and the amount of the response and the amount collected by the. This year we are expecting 2.1 lakh crore being collected in terms of IPO, and that number can only go up as we speak. So this all will has made the bank not to lend to corporates, but to focus then on the consumption loan and individual loan or personal loans. Side effect of that is the the NPS going up naturally because the stringent norms of RBI make them provide for the any slightest of the delay in repayment of this loan. So banks have seen a lot of pressure in terms of their profitability this time around, and a huge rise in their NPS in general. So that then bank, IT and auto all put together make 42% of the Nifty. So we don't see in short term at least Nifty can move up in a hurry, or they can surpass the old high just because of this the percentage or composition of Nifty. Second half of this year is going to be better, and I think the interest rates been lower, rural economy might help. The government taxation effect is slowly kicking in, because the tax saving happens every month and not front-ended. Every month, the salary saving for lower tax is going to be beneficial. SIP numbers we've seen at 27,000 crores only going up every month. And also the raw material cost, oil been steady, and government is proactive in doing the heavy lifting by spending more on capital goods or capex to generate employment. All that will look good in the second half of this year. That's a hope, and we feel the taco trade might take up. So Trump might come out with liberal terms with India eventually post the negotiation, and all that will end into some kind of a positiveness. Why we are so worried at this stage in terms of valuation? Because market is perfectly priced. There is no scope of any disappointment. So any disappointment in terms of results or quarterly results, forget Q1, we are virtually through that. But even going ahead, Q2 and Q3 need to be closely watched. So any disappointment there might lead to some kind of a correction, and that is what exactly has happened. Post results season started, market has gone down by about 1,000 points in terms of Nifty. We are at 25,600 has become now 24,500. So 1,000 point correction already happened, 5-6%. And I think we might wait there. So market may not drop further below 24,500, and the worst case it could go to 23,800. That was the technical analysis say. And before we end, India is still a fastest growing economy. If you see the global trade, will we contribute the more? US will be 1.8, Europe 1.5, China could be 4.5. So still we will be growing fastest. 5 trillion economy can become 7, 8 by just question of time. We do completely believe in the long-term story of India. This kind of blips or news flow happens, geopolitical things takes place, and even the any kind of eventual slowdown of 6.5% or 6% will take Indian stock market to much higher level. Why I'm saying so? If you just see with what has happened in last 4 or 5 years, 10-year return on mutual fund. I'm saying the flexi cap is still around 15%, mid cap is 18%, and small cap is around 18, 19% again, and large cap is about 13 to 14%. So this last 10 years, we have seen COVID, we have seen few wars, we have seen tariff tantrum from Trump. We have seen a lot of things. 1 year of full loss, 24, 25, we have not earned anything. After encompassing all that, the returns are still upwards of 15%. So what it indicates, somebody just stays in the market, believes the broader economic growth of the country, inflation under control, oil not going up too much for India because we import too much of oil, and our geopolitical tensions are subsided, which is subsided now. I think we offer a great opportunity in Indian stock market. So my request is to stay invested, irrespective of the news flow, because over a period of time, the fundamentals will prevail. The markets and good companies will keep on reporting good results, and those high growth companies will start reflecting in your Nifty or even fund for that matter. So for you, very important to choose is the right fund, right even stock for that matter, or right AIF. Allocation between debt and equity. You understand last year, liquid fund have beaten the equity returns in broader sense. If you have made 6-7% on debt fund, it's much higher than the equity fund. So don't forget debt allocation. They come very handy at times. Of course, proportion you decide depending on your time horizon and your risk appetite. But in generally 80-20, 60-40, 70-30 as whatever suits you. So debt has to be integral part of your portfolio. It can come as a 100% debt, though the taxes is not very favorable. But you can use hybrid funds to make it more attractive or more tax efficient. But the asset allocation become important, and the return differential also this year is going to be huge, like what we have seen last year. The best fund has given maybe 13%, that is Motilal Oswal's, I think, large and mid cap fund, and lowest could be anything like, which is minus 3-4%. So that kind of a variance we have seen last year, and is likely to repeat in 25-26 again. So be very careful about your asset allocation, choice of funds, and don't try and time the market. Today we are already at a very attractive level of valuation, provided the second half of this year is going to be good. So with this, I end my just a brief about what we expect going ahead for August of 2025. Thank you very much.